Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. All right, the source document we are narrating today is titled US Market Peripheral Notes 2026-0317, Tuesday. This video presents a direct informational narration of the source document. Okay, before we dive in, we'll start with the initial risk disclosure from the source. This document is provided solely for informational and research purposes and does not constitute investment advice, a recommendation, solicitation, or an offer to buy or sell any financial instrument. Investing in financial markets involves significant risk, including the potential loss of principal. Prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate materially and unpredictably. All strategies, market views, and analytical content are presented for reference only and do not constitute trading instructions, portfolio management guidance, or guarantees of future performance. So, here's the roadmap for today's report. First, we'll cover the macro backdrop and policy. Then, we'll jump into AI infrastructure and the supply chain. After that, we've got a section on index technicals and liquidity. Then we'll look at an institutional sentiment survey, followed by some single stock analysis. And finally, we'll wrap it all up with our market conclusion and outlook. All right, let's get into our first section, Macro Backdrop and Policy, with the subtitle, Geopolitical Shock and Intervention. Right now, the market is in a phase where it's incredibly sensitive to these big macro narratives. Geopolitical risk, for example, travels super fast. It goes right through energy prices, straight into inflation expectations, and that really becomes the main thing messing with the Fed's monetary policy framework. The price action we saw today perfectly traced this whole sequence. First, a geopolitical risk pulse, then a hedge based on policy expectations, and finally, a return to normal sentiment. So proactive intervention from economic advisor Hassett was absolutely key in calming down the equity risk premium. A few key things came out of his remarks. First, on liquidity support, he was very clear that the scale of a globally coordinated strategic petroleum reserve release would get bigger if needed. Second, he gave this controlled situation view, basically saying the Middle East situation was already under control and should be over within weeks. And third, he helped anchor prices by pointing out that futures markets suggest oil could drop back to a range above $50 a barrel later this year. Well, as soon as the White House sent that strong signal, oil prices quickly reversed their gains, the 10-year Treasury yield dipped below 4.2%, and that drove a broad higher open across all three major indices. Now let's pivot to Section 2, AI infrastructure and supply chain. The subtitle here is NVIDIA GTC and the shift from vision to delivery. As NVIDIA's GTC conference is hitting its second day, the whole AI story is making a really big shift. We're moving from the vision stage to the delivery stage. And this tech upgrade isn't just about better performance. It's literally reshaping the entire logic of the underlying infrastructure. So when we talk about technical milestones, the release of the Rubin Ultra architecture, the LPU inference chips, and the full liquid cooling tech at this conference, well, that's signaling that we're entering a whole new era of compute density. This is a huge boost for core chip makers, but it's also a massive catalyst for the entire value chain. We're talking PCBs, optical modules, and liquid cooling solutions. Now, in terms of applying research tools, investors can use features like an industry chain map. This lets you visualize the supply chain, breaking down NVIDIA's exposure across different areas like AIGC and AI servers. It also helps with optimizing trading strategies, where pro traders can use options functions to find bullish directions and expiries that line up perfectly with the GTC conference window. Okay, on to Section 3, which covers index technicals and liquidity, subtitled The Battle Around Key Support. Underneath all the tech euphoria, the broader market is hitting a pretty serious pause. Right now, we're in a classic tug-of-war between the bulls and the bears, and the technical indicators are showing that momentum is getting close to exhaustion. Let's run through the major index performance. For the S&P 500, the index bounced back up to its 10-day moving average at 6750, but it's stalled right there. The daily candlestick closed as a bearish doji, which really shows some hesitation from the bulls. Now for the NASDAQ 100 or QQQ, that 595 to 600 range has really been confirmed as the key lifeline. And even though it's held up after multiple retests, all of that repeated probing of support is using up the available dip buying demand. And here's a huge factor when it comes to liquidity pressure, the buyback blackout window. Data from Goldman Sachs shows that right now, 45% of companies are in their buyback blackout period. And get this, by the end of the month, that number is going to be over 80%. What that means is the market has lost its single biggest source of demand, and you can really start to see the liquidity pressure building.
But despite all that pressure, there is actually potential for a short squeeze. Even though the systematic selling by CTAs isn't quite done, the McClellan oscillator, which is a measure of market breadth, has already hit a more oversold level than the low we saw back in April of last year. An extreme oversold condition like that means any piece of good news on the geopolitical or policy front could easily trigger a really violent short squeeze.
And that leads us right into our analysis in Section 4, the Institutional Sentiment Survey, subtitled Repricing of the Risk Premium. This stalemate we're seeing between the bulls and bears is also showing up in how institutions are positioned, and it's a clear turn towards playing defense. Both as March Global Fund Manager Survey really gives us the data to back up the market's current risk-off mood. The most important point here is cash allocation. Fund managers' cash balances shot up from 3.4% to 4.3%. That is the fastest pace of cash accumulation we've seen since the pandemic, which tells you institutions are cutting their risk exposure aggressively.
And this is happening alongside something called a tail risk rotation. The market's perceived largest tail risk, that low probability, high impact event, has officially shifted. It used to be the AI bubble, but now it's geopolitical crisis and renewed inflation. This repricing of the risk premium is causing capital to spill over and diverge across different sectors.
So, this brings us to Section 5, Single Stock Analysis, with the subtitle The Spillover Effect of AI+. The whole AI theme is creating this cross-sector spillover rally, but it's a real mixed bag. You've got some genuine commercial deployment, and then you've got some illusory speculation mixed in there too. Let's run through some key single stock developments. First up, Rocket Lab, or RKLB. It pulled back after a huge rally on a space data center idea. Then management announced a $1 billion equity offering. Next, private credit firms like Blue Owl and Eris moved up on the idea that a secondary market is improving their funding liquidity. For Uber and Lyft, they bounced back after Uber launched an NVIDIA-powered autonomous fleet, with Uber taking back its 50-day moving average. In airlines, Delta, or DAL, jumped 6.56% as strong travel demand managed to offset higher fuel costs. SoFi, or SoFi, narrowed its losses after Muddy Waters made allegations about manipulated valuation metrics. And finally, for some new IPOs and momentum names, SWMR absolutely surged 520% on its drone IPO, while NBIS pulled back after raising $3.75 billion to build data centers.
All right, now for a quick deep dive on a key name, Qualcomm. We're going to focus on its dilemma and defensive positioning. As one of the legacy chip heavyweights, Qualcomm is kind of caught right now between a fundamental vacuum period and a shareholder return program.
So here's the analysis. First, their capital allocation strategy. The company announced a $20 billion stock buyback program and a dividend increase, which honestly looks more like a defensive move. Second, it's under pressure during an earnings vacuum. The stock's fallen 30% from its $183 peak, all while global smartphone demand is weak. This leads to the analytical conclusion. Even though the company's strategic shift into autos, PCs, and data centers is the right move, the near-term scale of those new businesses just can't make up for the decline in handsets.
Okay, let's bring all these threads together in our final section, number 6, Market Conclusion and Outlook, subtitled The Bull-Bear Tug-of-War. When you put it all together, the U.S. equity market is in a classic bull-bear tug-of-war, not a one-way trend.
So the crucial question really becomes, will QQQ hold or lose the 595 level? The answer to that is going to determine the market's next direction. If that support level breaks lower on heavy volume after all these tests, the market could shift from just bouncing around into an accelerated move to the downside. On the flip side, that deeply oversold McClellan reading points to some latent squeeze potential. This level is absolutely the key tactical focus. So based on that context, here's the outlook for positioning and strategy. On the positioning front, investors are really advised to stay highly cautious ahead of Wednesday's FOMC rate decision. For more active traders, professional tools can be used to dig deeper into opportunities along the supply chain. Also, account opening incentives that the market's referencing might be useful for optimizing the carry on any idle capital. Look, at this stage, maintaining liquidity and defending those key support levels is way more prudent than just chasing strength indiscriminately. And now we will conclude with a full professional risk disclosure and important notice. This document is provided solely for informational and research purposes and does not constitute investment advice, financial advice, trading advice, or any recommendation, solicitation, or offer to buy or sell any security or financial instrument. The author is not acting as a registered investment advisor, broker-dealer, financial planner, or fiduciary. No advisory or client relationship is created by the publication or use of this document. Investing and trading in financial markets involves substantial risk, including the possible loss of principal. Continuing the disclosure, prices of equities, indices, derivatives, digital assets, and other financial instruments may fluctuate significantly and unpredictably. All market views, analyses, and discussions are provided strictly for informational and educational purposes. They do not constitute trading instructions, portfolio management guidance, or any form of guarantee regarding future performance or outcomes. Any investment or trading decision made based on this document is undertaken solely at the reader's own discretion and risk. Readers are responsible for conducting their own independent research, verification, and due diligence. Past performance and historical analysis are not indicative of future results. Market conditions may change rapidly, and information contained herein may become outdated without notice.